Thank you, David. Very helpful, setting the scene, as they say. So I know there's a lot of interest with the Q&A, so I'll try to limit my questions, very short and quick. First question I'll have is for David. We're starting early now. We're new, as it's been said repeatedly, as a capital market, a latecomer. So a couple of questions that are related, actually. So kind of in the early stages, the theme of this session is the role of regulation, technology, and human capital. So, following along those lines, what's your suggestion, based on your vast experience in the securities exchange industry and capital markets in Nairobi? What do you suggest, in the early stages of development? How do you propose achieving a harmonious balance, if there's such a thing, between regulation, technology, and human capacity or human capacity building? Because these are all things we're trying to develop as we speak.
So very well, and thank you very much. So the capital market is an ecosystem where various players have to be put in place. And for the capital market to be fully functional, there has to be a very critical layer, and that is your capital markets proclamation. So it's very, very important that, number one, you have a proclamation, and we are happy that Ethiopia has it, that is being championed by a full-fledged regulator. And I'm happy to have CMA in place. So the CMA must have a very, very key objectives, because those regulations, the objectives has to be investor protections. And how does then the CMA ensure that there is that investor protections? One, you have to require that all the participants who are coming into your market, be it, say, a bank issuing securities, disclosure will be very, very important. So that at the end of the day, when an investor is buying a share of Bank X or Company X, then they know they are buying a share based on some information. And that's why the research reports that, like the one that was put out before these sessions, will become very, very important. I must also mention that the authorities will never remove the risk. The authorities, I want to repeat, will never remove the risk, but their work is to ensure that the investors are aware, so that when someone is putting money in a risky investment, they know what they are doing. To your second point around technology, technology will be used across the spectrum. And I'm very happy that you're starting from the point where you do not require share certificates. So technology is going to ensure that there is efficiency in terms of the way you are doing business. I can tell you in Nairobi, we started by having the market about 20 years ago, when you sell a share, you used to receive your money after 10 days because we were manual. Now with technology, we know that in this part of Ethiopia, you will be able to start your settlement cycle, probably based on the international best practice that speaks to 3 days. So that when you buy your share, after 3 days, your share is in your account. When you sell, equally, your money is in your account. I think based on the partnership that has been proposed here, that payment, in our view, should even be instant. There is no reason why someone should sell their shares and they are waiting there after 3 days. I think partnership with your MNOs and fintechs will play a key role to ensure that that settlement leg is reduced even from 3 days to near real time. Finally, the capital market is a factor of the people. You have to invest in different skill sets. When you're speaking of, say, a stockbroker, you will need investment bankers. It is a whole host of investment in that space in terms of personality. The way it worked in Nairobi is that the exchange and the regulator have to come up with programs that are pointing to directly certifying the players who will come into that ecosystem. Because the greatest risk in the stock market is actually the human error. You can imagine when you have a stockbroker trying to buy X number of shares, they are trying to buy 10,000 shares and they buy 1 million. And we say, whatever you have put in that system, you must deliver. So you wanted to buy shares worth 10,000, you buy 1 million, you have to look for that money. So to your question, human capital will be very, very important, and it has to be at the intermediary level where the brokers are sitting in. It has to be at exchange level, because you also need exchange people to understand the market so that they come up with policies that are supporting the market. Finally, at the regulator level also, it will be very, very important to invest in that capacity. You need capacity that can be able to interrogate those financial statements. You need capacity that can be able to process approvals, so that it's an end-to-end spectrum that will be driven by people and technology. Thank you.
If I may add, I think just a follow-up question I have, I thought of it now as I was sitting here. We have a lot of the decision makers for the banks, as well as other bank professional employees here. Kind of on human capacity, what should banks be thinking about? Well, what do you advise from your perspective, given that we're starting late, we have new infrastructures and everything you've mentioned already? What would you advise to banks who want to become service providers or participants in the capital market?
So yeah, my first advice is that all banks must participate in the capital markets, and they must make a decision as to which side, because banks play in both ways. A bank should see the capital markets as an enabler to its long-term strategy in terms of getting patient money. So the bank needs to make a decision. Do I want to go to the stock exchange and list through an IPO? Do I want to go there and list by introducing my current shareholders? Do I want to go to the stock exchange and raise money through a bond or an equities? So that's the first decision that the bank needs to make now. The second decision that banks need to make is that in the intermediary space, I have told you for all the banks, you must have a custodian license. That is a must, because I know most of the banks that are sitting here, they have registries. You can imagine when the stock exchange comes in, and one of your depositors wants to participate in the stock exchange and buy shares, and you are comfortably telling them, go to my competition and buy shares through them, because they already have that license. So banks must decide, what license do I want between the stock brokerage license and the investment advisory license? That is very, very important. Finally, banks must now start investing in partnerships. From what we have seen in our Kenyan markets, we are transacting in excess of 36 trillion, that is 3 times our GDP, through mobile money. So our expectation is that even here, and you know we are half your populations, so you can double that. Banks now need to be engaging in partnerships that will speak to how are we going to transact business, especially from a capital markets preposition going forward. We think partnership will be a key element, and every bank here that is pointing towards the future should be thinking of a fintech and a MNO that can be able to support their propositions. The details, as they say, the devil is in the details. Through iCapital and ourselves, we can be able to untie what that means going forward. I thank you.
Thank you very much. Moving on to Marion, just so you have, it'd be very interesting to hear from you. So, you know, Elsa gave a very good presentation on dematerialization, what a CSD is. But in practice, from your experience, how would you go about explaining, maybe providing a simplified explanation of these concepts? You know, it's new for a lot of us, but it's very critical. So just a simple way of explaining what a CSD is, how dematerialization works, you know, as we move from physical securities to electronic securities, etc. It would be good for you to expand on that.
Oh, thank you, and good afternoon, everyone. As we've been told, dematerialization is really converting the physical certificates into electronic form. It really sounds very easy. It is easy, but we need to realize the phenomenal benefits it will bring to the country and the whole capital markets infrastructure. So, in simple terms, there are companies, banks, insurance companies that have already issued shares. They issued certificates. The shareholders are holding their certificates. So what we want to do is to ensure all those shares are in the central depository system. We are putting in a state-of-the-art system that we have ensured that all the risks have been taken care of. And so the security, the safety of those securities is ensured. And then also the fact that it is central, it will be in one place. So what that does, it sets the stage for an automated trading system. Because now you don't trade, then you have to take certificates between the issuer, the broker, the exchange, trying to have them verified. And that process takes a very long time. It used to take anywhere between 14 days and several years before a certificate is verified for sale. But now when we move them into an electronic platform, which is now the central depository system, that means they are easily and immediately accessible, so that we can actually achieve straight-through processing. A client can actually use their phone to see what they hold in their account in terms of securities. That means then they don't have to have a certificate that they have to treasure and see how to do it so that it's not lost or destroyed. So in this case, the securities will be in electronic form. The same way you put your money in the bank and you know that your money is safe in the bank. Now you'll put your securities in the CSD, which becomes like the bank, but for securities. So your securities are safe. You don't have to worry about them being stolen or lost. Then you can access. You will have a portal to access and see which holdings you have in which securities, what corporate actions have been paid or announced. And then over and above that, when it comes now to the banks that are here, the issuers that are here, what benefits will accrue to you? The first thing is that there'll be no more printing of certificates. That one, you have already lowered your costs. Secondly, your securities are immediately held in a state-of-the-art infrastructure, a robust system. So you don't have to worry about buying another system to hold your register. That has already been taken care of by the CSD. Then thirdly, an automated processing of corporate actions. You don't have to do any manual processing of dividends or bonuses. Everything is automated in that system. And you'll be able to access that system and do your corporate actions. So again, what that does, it speeds up the time. So you do it in a shorter period. And secondly, you eliminate manual processes. Thirdly, when it comes to transactions, in the manual space, you have to have people there verifying the certificates and transferring now from the buyer to the seller. All that ends. Everything is done between the exchange and the central depository. Once a client trades, they buy shares or they sell shares, that whole process is automated, and the buyer will get their shares and the seller will get their money through that whole ecosystem of the central depository. Now, when we look at the side of the investors again, first we say the risk is minimized because you can't lose your shares now, or they can't be stolen. Then secondly, there's easier access because of technology. There's online platforms, there's mobile apps where they can access and see what they have. Then thirdly, those securities can be used as collateral to get a loan. So in the current regime, because they are certificates, it's kind of a long process to take it to the issuer, then go to the bank has to confirm with the issuer. In this instance, the securities are already verified, they are held in a a securities account. All it takes is your bank to issue an instruction to the central depository to pledge those shares, and the bank can immediately release those funds to you, and you're able to have easier, faster access to funds. That can even be taken further if the banks have the platforms to do it on a mobile platform. Someone is able to request for funds on their app on the mobile phone. The bank is able to connect with the CSD to confirm that the securities are there, pledge them, and then immediately release the funds to the person who's seeking funds. That means you're able to access funds quickly, much more than what is happening at the moment. In relation to this entire ecosystem of the capital markets, then what does dematerialization bring about? There's increased efficiency. Transactions happen much, much faster. Settlement is easier because the CSD is connected to the trading platform and even to the payment system. So when a trade happens, it's reported immediately to the CSD. The CSD confirms the securities are there, moves the securities, moves the funds. It can happen in an instant when we have the securities in the central depository. Secondly, there'll be increased liquidity because the faster you are settling these transactions, the faster these securities are available to trade again. So that means this market will start with actually very high liquidity as opposed to a market that starts in the certificate physical form. Then again, there's transparency. Everyone is able to see the trades that are happening. Everyone is able to view their account and see what they have. And that is enabled by the fact that now that there will be technology and everything is electronic. I would like to stop there. Thank you.
Thank you very much. It's very interesting. I can't add much more, but I think the main takeaway, I think, for the audience, I think for the layman would be we're leapfrogging quite significantly. I think David mentioned T plus 10 days that they were settling before, not long ago in Kenya. I can assure you in our market it won't take more than 3 days. And that's at the start, at inception, maybe even less if it's a debt security, for example. So we will leapfrog. It will bring a lot of efficiencies. I think it's an underappreciated aspect of, we always talk about the exchange or the authority or brokers, but the CSD actually makes everything run. It's like the engine for capital markets. But with that note, we have about 20 minutes. So I think let's move on to the Q&A. I've been warned we have to stop at 1 o'clock, so I'll be very regulating on this. Let's try to introduce ourselves as we ask questions. Introduce yourself, state your name, and target your question to which presenter or panelist, just for efficiency. Maximum 2 minutes per question, please. So let's do 3 people first, and we'll come back. Right there. Atomelaku, I guess. And we'll try to do some gender diversity, so ladies, please raise your hands as well.
Thank you, Miguel. My question is to Bethel and Kioi. In regard to dematerialization, as you mentioned, as far as we don't have a kind of straight-through processing, things will be easy on the buyer and seller sides. But my point is, at times those security holders want to use it for collateral purposes in lending. How? Because there is intrinsic nature over there, and finally, even when it is going for foreclosure, it's a bank right to sell it. Is that also automated in the CSD systems in regard to managing the collateral part of this security? Thank you.
Thank you, ladies and gentlemen, for the insight you gave us. It was really interesting to have you in the mix of the panel. Having said that, I have some remark to Temesgen's presentation. When you compare microfinance and banks with respect to their performance, especially return on equity and asset, I think it is not appropriate comparison. Even your assertion as to the mismanagement of asset by banks is not appropriate. You know, actually, you are comparing apple with some other fruit, okay? Banks are engaged, they are supposed to make a huge investment because of their nature, while microfinances can operate with a slight investment on assets. So it should be corrected. If you compare with respect to return on equity, the result is reversed from the return on asset, which ranges from 21% to 32% for banks and 9-point-something% to 16% to microfinance. So the issue is not about efficiency or about mismanagement, rather it is about the nature of the institution. So it should be corrected that way for the audience. My other question is to David, Mr. David. Thank you for reflecting in a few minutes about the 17 years journey of the capital market of Kenya and your experience as well. You know, what I wanted to just seek to share with us is, how do you get the journey of awareness creation and orientation to the role players from physical certificate to sharing account? Partially, my concern is raised by my colleague, my friend, Mr. Malaku. You know, how difficult is it to just onboard the role players, which is shareholders, you know, from physical ownership to some virtual ownership, which at some time may pose some challenge, especially in our country. It is a common practice to just offer share certificates as a collateral for lending. So let's ground the challenge we are supposed to go through to just change the mindset of the role players. Thank you.
Thank you. Maybe one more question? From this side, maybe? Anybody? In the back, very far back. In the far back.
Thank you. I am Ayala from Addis Ababa University. I have some few questions, especially for David and his team. As you know, this thing is a little bit new for us. So, you know, from your experience, I expect you would, you know, share us the safe way of navigating the fulfillment of the ecosystem in the Ethiopian capital market spectrum. So my first question would be, what is the relationship between securities custodian and the CSD? I'm raising this question because I was thinking immobilization has to come first than that of dematerialization. So maybe my friend from the ACMA was presenting there are, you know, some millions of shareholders, so that we can also assume that this number of shares are on the hands of shareholders. So that share has to be collected and safely kept to the custodian. So that is what I'm thinking. So that is immobilization. So the next step would be to demat it, right? So that dematerialization, I think, is the responsibility of the CSD, whereas immobilization is the responsibility of the custodian. So what is the demarcation in this regard? And how can we link this process with that of the registry? And who is responsible for having the security registry? Because, when it comes to dividend, share splits, and, other issues, again, the registry has to be there. And is the registry going to be part of the corporation or the issuer, or it's going to be part of the CSD? And the other question would be, which one is beneficial for us to move? Can we move to direct dematerialization, or we can transit from immobilization to dematerialization? Which one is safe? The other thing, what is your experience in protecting digitally illiterate investors while we demobilize the securities? These are most of the questions that I have raised is for David and his team, because I want to know the practical aspects in Nairobi. And maybe this is enough. Thank you.
Thank you. Let me try to distribute the questions. The first question, I think, was about collateral management. So if you're doing securities lending and borrowing, maybe Marion, if you want to address it. How does it work exactly?
Okay. The way I understood the question, he was asking about managing the securities that have been provided as collateral when someone takes a loan from the bank, right? So this is what happens. We have the bank, we have the central depository. First and foremost, there has to be a relationship between the two to establish the role of each party in that process of pledging and the loan and everything. Secondly, when the bank issues an instruction to the central depository to place a lien on those shares, then the central depository places that lien immediately and confirms to the bank. And it's only when the bank gets the confirmation that they can release the funds to the person that is borrowing the cash. Once that lien is placed, those shares cannot be accessed by anyone, not the broker, not the investor, not even the CSD, until again another instruction comes from the bank saying now that this person has cleared the loan, their shares can now be released to them. What that does is that it gives a confidence and a guarantee to the bank that those securities are safe and they cannot be accessed. Secondly, in case of a default, if this client defaults on the loan and they are not able to pay back, the bank has the right to foreclose on those shares. So with that ecosystem, again, there's the bank, there's a broker, and there's a CSD. So the broker that this bank appoints to sell the shares on their behalf, the bank will authorize the CSD and tell them we are foreclosing these shares so that the shares can be released and sold, and then the proceeds will be then sent to the bank. I hope that is clear.
Thank you, Marion. And obviously others are welcome to add if necessary. Next question I think is for David. There was a very good question about awareness creation, what your journey is from physical to electronic, especially from a market side, if you can reflect on that.
So yes, the question here is how do we transition from our current registry that your shareholders currently have a physical certificate to the physical form? And to your question, it is not going to be easy because we know we are all Africans and we love physical certificates. So how do you manage it? One, there has to be a very well guided process of public awareness that is being driven by the current issuer. So if today Oromia Bank has, given that you have asked the question, wants to transition from physical to immobilization and to the DMAT. Then Oromia Bank, because it's the trusted entity by your shareholders, has to lead the pack and inform and reach out to the current shareholders. That is a good thing. The most fortunate thing we have seen is that you are a commercial bank. So I am sure you don't give your depositors certificates when they deposit money. So it's the same concept. You will need to have a campaign that is speaking to the fact that you are depositing this certificate to the electronic form. Just say your money is deposited with us and you don't have a certificate. So that's very, very important. Number two, at the CSD level, the authority need to ensure that there are risk management tools through fintech, so that if you are depositing a share in a CDSC and that CDSC is tagged to a certain broker, in the event that there is any activity in that account, I should get an alert as an investor from my phone that someone has sold my shares, so that if I had not given that instruction, then I am able to reach out and that situation is corrected. So you must have a double-edged approach. The good gentleman at the end has also asked the question, how do you go about it? Is it from certificate to DMAT straight away, or DMAT, from certificate, immobilization, and then DMAT? From our experience, we would advise, respectively, that it will be easier for you to go through the whole process. Because remember, and this is based on the experience that we had in Nairobi, we started from certificate to immobilization, because that is the right of choice to the investor. And you ensure that the ones who you have carried, you give them that right of choice to convert. Then downstream, and supported by your regulators, you now come up with a rule from a regulation perspective that says, going forward, any public security has been declared DMAT, because that has to be entrenched in law for it to happen, and it needs to be entrenched in your respective memorandum and articles, and it has to be sanctioned by your general assemblies. So for me, in terms of ensuring that you carry everyone, don't force. Carry them through this process, make sure that they convert through immobilization, and then downstream, you can declare the securities DMAT. It's a process, but your public awareness campaign at company level, at regulators level, at exchange level, has to start, because that's the most difficult, because you will never satisfy public awareness, but you must have to start doing it. Thank you.
Thank you. I think that was a very good answer to multiple questions, actually. So maybe just Elsa, just so you can chime in or share your perspective. I think one important question that came up was, this is new for us, and what is a safe way of navigating this? So maybe from a legal perspective, how would you say we're improving and making things safer going forward? Just from your perspective.
Okay, thank you. Transferring different countries use different mechanisms. Some of them use immobilization, some of them just go straight to dematerialization. In our case, we are having all things as previously discussed, all infrastructures, all the ecosystem in trading, the exchange, the depository, all together, the regulatory. So for us, it could be either ways, going immobilization first, taking the securities from each individual and locate in a safe place, and then later on dematerialize into full DMAT. However, think of it like when most of us here are bankers, so I have been in a bank industry too. When we requested for deposit mobilization, the same resistance, the same efforts have been required from us. So it is a process. We'll see how the
the issuers and investors will act. And in my opinion, full dematerialization would be preferable, because we have all the infrastructures, and we would like to match with international best practice, and the competitions and everything will be preferable, and it will go coherent if we use the dematerialization process as full demat. However, the business and the ecosystem will be, I think, will be leading us forward. And to add with what Marion previously said, in the process of dematerialization, those pledged securities will be taken into the central securities depositories. The information will be taken from the issuers, and those pledged securities will still be captured in the central securities depository. Thank you.
Thank you, Elsa. I think Marion wants to add something, so we have a few minutes, just 1 minute.
Yes, just a very quick one. When you look at the Capital Markets Proclamation, Article 42 requires that all public securities shall be registered in the central depository. So that's why we are saying all the registers have to be moved to the central depository from the get-go. So once they are deposited in the central depository, we'll still give the opportunity for the shareholders to come, open an account with their preferred broker or custodian, and then now move those securities to their own accounts there, where they'll now be able to trade. But from the very word go, the public companies will need to register all their securities with a central depository. Thank you.
Thank you. We literally have 3 minutes, so we have room for one question.
You buy a million, you have to look for that one. So to your question, human capital will be very, very important, and it has to be at the intermediary level, where the brokers are sitting in. It has to be at the exchange level, because you also need exchange people to understand the market so that they come up with policies that are supporting the market. Finally, at the regulator level.
My name is Amanuel. I'm an investor.
Your slides are up. You can start.
Insurance.
Great. Okay, thank you very much. Pleasure to talk to you all. Thank you very much for the opportunity to talk to you all. I'll be very brief to talk about the.
When do you predict that this CSD's process will begin in Ethiopia, or the commencement period of this registration? As immediately as the exchange starts, or as the authority proclaim, when will it be started, the CSD's registration? And my second, the other question is, tell us about the relation between investment bankers and exchange. How about investment bankers and exchange relationship there? Also, how the existing bankers get an investment bank's license, and how they rearrange themselves for these investment banks. Investment bank is different from these conventional banks. The other is how this existing banks and share companies, just like real estates, which have more than 50 shareholders, will be evaluated and valued. How the evaluation process is done, with whom, and what about their par value for the next share to be issued for the shareholders, and how the roadshow in Kenya was performed. Do you have any experience to share?
There's about five questions there. We'll try to address
I finish
them
it.
all.
Thank you.
Sorry, we're just out of time, so we have to make us stop. So let's quickly try to answer this. I think commencement of registration was the first question. When will the DMAT take place? If you can just take 30 seconds, Elsa, to answer that. Difference between investment banks and exchanges. David, if you'd like to briefly talk about that. And then, I'm not sure if I caught the last question, but the roadshow, I can quickly cover that, and Temesgen will add something else as well.
The time frame is not yet been set. However, when the CSD, the Central Securities Depository, is ready, the securities will be migrated, but the templates are already ready, so they will be communicated to the issuers, so that the issuers will prepare the data on and put them on the templates. Therefore, the launch time will be in after about September to December. Then that time will be a migration, but the migration won't take that much time because it's just a system. You just download it or migrate it to the system. But the process of putting the templates and requiring identification of the stakeholders, the issuers, the shareholders might take some time. Thank you.
The second question was around the difference between the investment bank and exchanges. And I want to use a demonstration. If one of the sponsors here, Hybrid Bank, wants to use the capital markets and list their shares, they will take their shares to the Ethiopian Stock Exchange. So they will be a listed company, and any Ethiopian or foreign investor, for that matter, will be able to buy the shares of Hybrid Bank. Now, an investor like yourself who asked this question, you will not be able to go to the stock exchange directly. You will be able to have an account with an investment bank under your name. And when you want to buy the shares of the Hybrid Bank, you're going to deposit money in the trading account of that broker so that you can be able to buy the shares of Hybrid Bank. So to your question, the investment banks are the brokers who are going to support investors to be able to buy shares that are listed at the stock exchange. So that's the arrangement in there. Thank you.
Thank you. I think you asked a question about road shows, if I recall. If it's about the exchange, we completed that already. It was just a financial capital raising roadshow. So which finished, I don't know, many months ago, but we went to Nairobi, London, also here in Addis to raise equity capital for the exchange. So David just explained the difference between investment banks and securities exchanges. We're just a platform. We're providing a service for people, individuals, investors to trade shares, to exchange, to buy and sell. Investment banks are an actual service provider, so it's a little different. Lastly, Temesgen wanted to add in something. I missed a question earlier that he had, so I'll give him 1 minute.
Thank you. I think the question was raised on the inappropriateness of the comparing the return on asset between the microfinance and the bank. Of course, it was my concern also, because I have tried to address those things, the nature of the industries. So I will consider it. Even I didn't include it in the report, just I raised the idea to entertain simply. So that is the answer. Thank you for the concern.
Just to add on one question that has been raised related with the illiterate Ethiopian investors. The capital market service providers will be the one who will provide and perform the activities of the capital market, and the central depository participants also will be also the one who will assist and do the activities of the conversion of securities or opening of accounts. Therefore, capital market service providers like brokers, investment advisors, investment banks will be giving assistance and will give the services that the capital market will require from those illiterate Ethiopian investors. I just want to add that. Thank you.
Thank you very much. You know, the morning ran a little bit late, so apologies we don't have more time for questions. I know everybody probably wants to eat as well. So just want to give a round of applause to all our panelists.
Thank you very much, Mr. Mikhail. I see the ESX is in safe hands because that was the most efficient use of a session. Kindly, please join us for a group picture with the panelists on stage. And I would like to say that lunch for this breakout room is organized in the traditional room downstairs, just one floor downstairs. And we will have a chance to dig deeper in the opportunities of the capital market in the afternoon. So I'll see you back here exactly at 2 p.m. And we will start sharp at 2:15. So thank you very much. I see you back here in an hour. Traditional restaurant, just go past the exhibition center and one floor down. That is where lunch is served. See you back here in the 1 hour. Group photo, please, panelists. Give us some time. Thank you, sir.